morning, everyone, and thank you for joining us for our 2023 financial year in review. I'm Betsy Kenyon. I'm the marketing coordinator here at Elevate Wealth Advisory. If you're new to us, Elevate is a wealth advisory firm in Athens, Georgia, and we focus on preparing our clients to confidently live their best lives. We were founded 41 years ago by Chuck Vickery, who's here with us today. And we rebranded a few years ago to better reflect our growing team as Elevate. We're now led by Deanne Rosso, our president and CEO, and she's also here today. I'd like to introduce our two guest speakers, Mike Ozburn and Brian Haywood from Buckingham Strategic Partners. And that's the company we partner with in order to service our clients in a more meaningful way. We're so pleased to have Chuck with us, as well as Deanne, and then our wealth advisors here at Elevate, Clark Holt, Rob Fazekas, and Dee Dee Bloom. So welcome, everybody. Before I introduce Mike and Brian, just a couple items. Many of you have already sent in some questions for the team, but if you think of any questions during today's presentation, you can put those in the chat box or the Q&A box, and we'll answer those if we've got some time at the end. If we don't get to your question, you can email it to me at marketing@elevate-wealth.com, and we'll be sure to get back to you. Later today, you'll get a link to our recording on our YouTube channel, so feel free to share that with your friends and family. Now I'd like to introduce our panelists. As a divisional manager for Buckingham, Mike Ozburn partners with financial advisors like us to help us prepare better advice and investment experiences to our clients. Prior to joining Buckingham, Mike was with CNL Securities, working as a senior vice president, and his background also includes many years as managing director for a leading alternative investment firm. He began his career with Merrill Lynch in Jacksonville, Florida. Mike graduated from Florida State University, big game coming up, with a Bachelor of Science in Economics and earned a Certificate of Financial Planning from UGA. Mike and his family reside in Lookout Mountain, Tennessee. He coaches youth football, baseball, and basketball, and he also loves traveling with his family. Brian Haywood is an investment strategy advisor. He and his team spend their time customizing portfolios on behalf of Buckingham Strategic Wealth clients, upholding their fiduciary responsibility by doing what's in the best interest of each client. Brian's also a member of the firm's investment policy committee, lending his insight on the firm's overall investment strategy. Prior to joining Buckingham, Brian was in retail sales assistant for UMB Brokerage Services. He holds a bachelor's degree from St. Louis University. Brian is a passionate supporter for the Gateway Area chapter of the National Multiple Sclerosis Society, and he's a 7-time participant in the organization's Bike MS event, a long-distance cycling event that's raised more than $1 billion for the organization since 1980. Brian and his family are in Afton, Missouri. So Mike and Brian, thanks so much for joining us today. Why don't you give us a brief overview of 2023, and then we'll get to some of our clients' questions.
Sure, happy to do that. Thank you very much for the introduction.
Thank you.
Let me share my screen here. All right, can everybody see the slides okay? Mm-hmm. Perfect. Yeah, so we'll just go through here and do a quick review or wrap up of 2023. I can't believe it's almost over here in a couple of weeks. And then take a look at kind of what has driven markets in 2023, and then looking ahead to 2024, what's kind of the outlook for the upcoming year. So as far as performance goes, in the equity markets, 2023 was a really positive year for equity markets. You can see, obviously, a ton of green on this screen. So you can see here in the U.S. market, kind of these three bars. You can see U.S. stock market was, and these are all as of end of November. So you might be some slight differences to today, but I had to lock all these in at the end of November. So through November 2023, the U.S. stock market was up about 20%. So really, really great bounce back year considering what we saw in 2022. Unfortunately, value had a little bit of a challenging year. While it was still positive, you can see U.S. large value stocks were up about 5.5%. Small value stocks would eke out a small gain so far. On the international side, you can see the international markets were up about international developed stocks. So those exclude emerging markets. We're up about 12%. Value performed a little bit better in the international markets. You can see international Developed value stocks were about 12.6%, whereas small value international stocks were up about 7.2%. And then EM was up about 6% in 2023. So, like I said, really, really positive bounce back year after the troubles we saw in 2022. Now, just diving a little bit deeper into performance, specifically on the U.S. side, while the market overall looked really good with about a 20% return, I wanted to kind of point out that the bulk of that return has really been driven by, you might have heard of these referred to as the Magnificent Seven stocks in 2023. If you see been out on social media or seen in the financial media out there. And the stocks in question are Apple, Microsoft, Amazon. You can see them at the top there. And you can see they've had incredible performance in 2023. I mean, NVIDIA up over 220%. Meta, that's the parent of Facebook, up almost 172%. So the lines down here, what they represent are the lighter blue line is the S&P 500. So obviously done quite well, up about 21%. But the S&P 500 is a cap weighted index. So these stocks up here, they represent, with their returns this year, of about, I believe it's about 35% of the S&P 500 at this moment. Now, contrast that with this darker blue line. The darker blue line is the S&P 500 eco-weighted index. So it's an index where every company gets the same weighting. And you can see there a drastic reduction in performance. The eco-weighted index is only up about 6.6% relative to the cap-weighted index up about 21%. And again, that's really driven by these kind of Magnificent Seven stocks. They have been a huge driver, these high-flying tech stocks. They have been a huge driver of returns in 2023.
Hey,
Now,
Brian, one thing I want to point out is a little perspective too. In 2022, it was really kind of the flip of this story. Tesla was down 65%, NVIDIA was down 55%. And if we expanded this to 2022, only 3 of these 7 stocks would have actually outperformed the S&P 500. And I think that's a good lesson to investors, is that all these stocks are going to be in your portfolio, but we don't necessarily want to target 7 stocks because there is a ton of volatility. And maybe you can talk a little bit about valuations too with these stocks.
Yeah, so all of these stocks above, since they've had incredible returns, their price to earnings ratio are really, really high. So in general, the average PE ratio in the S&P 500 somewhere between about 20 to 25. Right now, most of these are trading at PE ratios, north of 40, some north of 50. So you're basically paying $50 for every dollar of earnings. So you're paying really, really high prices for these stocks. So are they likely to have these types of returns moving forward? I can't say no with 100% certainty, but it's going to be really, really challenging for these 7 stocks to have the same type of performance in 2024. What usually happens is when stocks have this type of multiple expansion, what usually happens is they have lower returns moving forward, and those multiples come down. That's typically what happens. So if I was a betting man, and I'm not saying to do this, but I would imagine that these stocks are not going to come anywhere close in 2024 to this type of performance. I could be wrong, but that's why we still hold some of these. We just don't hold them in as big a proportion to the market or in our portfolios. We lean a little bit more towards small and value stocks, so we just hold a little bit less of these in proportion. But we still benefited from this great run from these 7 companies. Now, as I mentioned earlier, what we've seen is, unfortunately, the value premium is started to come under pressure again as those large cap growth stocks, the Magnificent Seven specifically, outperformed. So you can see, 2021 and 2022 were great for value stocks, up 13, and obviously last year a great year. Even though stocks in general were down, value stocks had, relatively speaking, significantly better performance than growth stocks. What we've seen here is growth is unfortunately outperformed value again. So our value tilts have been a little bit of a headwind here in 2023. Now, flipping over to fixed income and our typical alternatives, you can see here U.S. fixed income had nice positive performance, up 1.6%. Intermediate treasuries were up about 2%, and inflation-protected bonds were up a little bit north of 1%. So what we've seen is, while we still have seen interest rates go up, rise a little bit in 2023, they have not risen anywhere close to the amount they rose in 2022. And most of that has been offset by the fact that income for these specific asset classes are now significantly higher. So you're starting off with yields on these areas of the market, north of 5% when it comes to specifically treasuries. So you're getting a lot more income from your fixed income, and that goes a long way in kind of insulating portfolios from some of that price movement. And I'll talk a little bit in a few slides about the outlook for interest rates moving forward into 2024. Now, as far as the alternatives, we kind of group real estate and commodities in there. I know we don't typically use commodities in portfolios, but just wanted to show what they did in 2023. So you could see real estate up slightly after getting pretty poor performance in last year. Commodities down pretty substantially, down about 5.4%, and the U.S. dollar was basically flat in 2023. Now, as I mentioned, interest rates have continued to move higher in 2023. Although you can see here, I mean, it's a long chart. You can see here they haven't risen nearly as much as they did in 2022. So the light blue line is a 10-year treasury. The darker blue line is a 3-month T-bill. So you can see they both rose substantially here in 2022 and have kind of leveled off a bit in 2023. But I do want to point out that the yield curve is still inverted. So you do have short-term T-bills still above the 10-year treasury. And what that's telling us is that's the market telling us that interest rates are likely to be lower at some point in the future. So I know it's tempting to kind of stay short with the yield curve being inverted, but there's been a couple questions about should we stay in cash or move out a little bit on the curve, and I'll address those in a little bit. But I know that can be tempting when the yield curve is inverted.
Brian?
But yeah, go ahead, Mike.
Oh, one other question there. Does an inverted yield curve mean likely we're going to see a recession too, or anything else we should take away from that?
Yeah, so that has been one of the signals that a recession could be on the horizon. Unfortunately, it's not the most reliable. While every recession has been preceded by a curve inversion, not every curve inversion has been followed by a recession. So there are times we do get some false signals. Now, coming into 2023, the conventional wisdom was the majority of market participants were expecting a recession in 2023. Obviously, significantly higher interest rates that should lead to reduced economic growth. But so far, we've actually seen the U.S. consumer hang in there, and I'll show that in a little bit. But one of the reasons we have seen kind of interest rates moderate to a degree is all because inflation has started to come down. So what we've plotted here is headline inflation, core inflation, and core inflation excludes more volatile sectors like food and energy. That's typically what the Fed is usually looking at when they're judging what inflation is doing. They're looking at core inflation. And then we have a third measure, Dallas Fed Trim Mean. Just kind of another tool that the Fed uses to assess inflation. And you can see there, obviously, inflation kind of peaked summer of 2022 and has been coming down ever since. But it is still, regardless of what inflation measure you look at, it is still well above the Fed's 2% target. So while the Fed raising interest rates seem to work so far as bringing costs down, there still is a way to go. So I would anticipate, the Fed to leave interest rates higher for longer. This is my own personal opinion. Chairman Powell is a pretty big history buff, and he does not want to be known as Arthur Burns 2.0. For those that don't know who Arthur Burns is, he was the Fed chairman during the 1970s. And what happened is, obviously, they had inflation in the early 70s start taking off. Fed raised interest rates to combat that inflation. It started to come down, but also at the same time, we saw a significant slowdown in the economy, and the Fed took their foot off the gas pedal too soon. They started lowering interest rates again. And what happened? We saw inflation come roaring back in the late 70s into the early 80s, where we had Paul Volcker really have to raise the Fed funds target rate significantly higher to kind of kill off not only inflation, but unfortunately, he kind of had to kill off the economy in the early 1980s to get that under control. And the last thing I think Powell, as well as the rest of the committee, wants to do is have a repeat of that. So my personal assessment is they'd rather be wrong to the side of leaving rates too high for a little bit too long, as opposed to lowering rates too early. But we're seeing positive momentum here. If I remember correctly, we get an inflation reading tomorrow. So that's going to really be a big number that obviously everybody in the market is going to be looking at to get kind of a clue what the Fed's going to do next. Now, looking forward, what is the market telling us with where rates are and other metrics? So looking at market-based inflation expectations, the market is still expecting pretty muted inflation moving forward. So the way these numbers are calculated is they look at the yield of a nominal treasury bond, and then they subtract the real yield on the corresponding TIPS bond, the corresponding treasury inflation protected security, which is at a real yield. And the difference between that nominal yield and that real yield is the market's expected inflation over that time period. So you can see here over the next year, the market's really only expecting a roughly 2% inflation. And it really doesn't get much beyond 2%, even the farther you go out. Even at the 30-year mark, they're only looking at about 2.3% inflation. So the market is pretty optimistic that the Fed will be successful in terms of bringing inflation down to their roughly 2% target. Now, looking at Fed funds futures, what are they saying about what the course is of the Fed as far as the Fed funds target rate? When do they think the Fed will start lowering interest rates? And right now, the Fed funds target rate is 5.25 to 5.5. And based on Fed funds futures, it's looking like kind of in that March or May timeframe, the Fed might start lowering interest rates. And the consensus now is probably looking at, roughly 100 basis points in cuts or 125. It's kind of 50-50 on that last 25 basis point cut. So the market's anticipating the Fed to start lowering the target rate in 2024. But I'd say all of this can change very quickly. For example, the next inflation print we get, if it's a hot inflation print, it's higher than the market's expecting, you could see this math change pretty dramatically and very quickly. So I would take this a little bit with a grain of salt. It's the best guess we have at the moment, but it can change quite significantly, given that the Fed is so data dependent right now. You could also see us get moved forward if we get a really good inflation number. So we'll see when we get that information for November.
What rate does what is, can you explain what the Fed funds rate is and what the Federal Reserve actually controls as far as interest rates?
Yeah, so essentially the Fed funds rate is the rate the bank charges, the rate banks charge to lend overnight. So it's a very short-term interest rate, but so much of the rest of the rates within the system are based off of that rate. So the Fed can't actually lower treasury rates or raise treasury rates, but through the Fed funds rate, they can kind of give a signal and force other rate, I should say force, but encourage other rates to fall. The Fed funds rate is just one tool in their kit. Obviously, they also have a balance sheet that they can use. You've probably heard of this term quantitative easing or quantitative tightening. And what that means is also the Fed can go out in the market. And if they want to lower longer term rates, market interest rates, they can go out and buy treasuries and take, do that to I shouldn't say that. Yes, to lower interest rate, or they can sell treasuries out there on the open market to increase supply and lower, or excuse me, increase rates as well. So they've got a couple tools, but right now they've been using the Fed funds rate so far. Looking over on the far right, looking at S&P 500 earnings growth estimates. So you can see kind of earnings estimates are still positive, but they are starting to slow down, which is not surprising. That's exactly what the Fed is trying to do. They are trying to slow the economy down, so there's less consumption and we can get inflation under control. So we are starting to see the earnings estimates starting to come down. So it looks like the Fed policy of raising interest rates is starting to work. Just to give you an idea, the average time it takes for kind of from the start of a tightening cycle to it starting to filter through to the rest of the economy ranges from anywhere from about 12 to 18 months. So the Fed really started stepping on the gas in kind of spring, summer of 2022. So we're basically kind of right at roughly that 18-month kind of time frame. So this is kind of expected given what the Fed has done. Now, as I alluded to earlier, the market was expecting a recession in 2023, but what we actually saw is pretty strong growth in as far as GDP goes. In 2023, the U.S. consumer really was very resilient in the face of continued high inflation. So you can see here, Q1 and Q2, economy grew roughly 2%. And we actually saw, in terms of real growth, about a 5.2% growth in the third quarter. Now, some might say that's people, kind of buying early in recognition that inflation is still out there and kind of stocking up for Christmas and whatnot. So we'll see. We'll see what Q4 brings. But so far, the U.S. consumer has really hung in there, and there's been pretty strong growth, and that's why we've seen the U.S. equity markets really hang in there in 2023. Because the consumer has remained there. They're still buying products. They're still going out there and spending. Now, moving forward, we've actually seen as you can see here, we've seen projections rise. So in 2023, the June projection was about 1%, and you can see it's moved up to about 2% looking forward for the remainder of the year. You can see 2024 risen again. And this is looking at the Fed dot plot. So the Fed every quarter puts out their summary of economic projections, and they project forward what they expect the Fed funds target rate, as well as a number of other economic metrics. So you can see here, because the US consumer has remained resilient, the Fed has increased their expectations for growth moving forward, at least in the short term. You can see kind of longer term, 2025, and then long run about the same, but positive, but more muted growth. I mean, 1.8%. While it's good to see the economy growing, that 1.8% growth isn't exactly an economy on fire either. So there's the combination of higher interest rates. We've also got obviously significantly higher debt from a U.S. economy perspective as well. That should over the long term probably curtail growth to a degree. And that kind of concludes my slides. I'll stop sharing my screen here. We can kind of open things up to Q&A.
So Brian and Mike, this is Deanne. Thank you guys so much for being with us today. And for those comments for both of you already. We've gathered some questions from our clients and from our viewers that we wanted to ask you guys while we had you with us. So I'll start with the first one. And some of this you've already alluded to, but last year at the end of 2022, we're sitting here with a bunch of red on the screen. Markets were down. And from the slides that you just showed us, we saw lots of green, which we like. For 2023, markets have come up. So fast forward the year from this time last year to now, we see positive rates of return. What happened? What transpired to make that happen?
Ultimately, it was a combination of, looking forward into 2023 towards the end of 2022. The expectation was, with interest rates being significantly higher, with inflation being where it was, the expectation was, there was likely going to be a recession, and some were saying some were saying, hey, maybe it's going to be a mild one. Others were predicting a little bit deeper recession, but ultimately the expectation was, by most market participants, we'd see some kind of significant slowing of the U.S. economy in 2023, and it just didn't happen. You saw the growth rates. We still grew in the first half of the year by roughly 2%, and then really strong growth in the third quarter. So basically, the market defied the U.S. economy defied expectations, and so we saw strong growth in the U.S. equity markets. When you get that kind of growth, when expectations are low and they're exceeded by a pretty substantial amount, we see that positively reflected in the U.S. equity markets, as well as in the international markets also.
Hey, Mike and Brian, it's Clark Holt here. I appreciate y'all being with us. We're coming into an election year. We've got inflation that we've just experienced and still experiencing somewhat. 2 wars, lots of events, lots of things, lots of concerns. And the question is, this does feel different. And oftentimes we get caught up in saying that it's different this time. And is this different? And can markets offer or provide us with a positive experience, even with these concerns, events, or headwinds?
Yeah, great question. So I would first say the equity markets are one of the most efficient machines as far as processing all information. So everything you just noted there, the 2 wars we're experiencing, the fact that next year is an election year, all the other economic headwinds that you noted, those are all obviously well known by the market and already kind of priced in to where we sit today. Now, obviously, if new information comes out, certainly that will affect markets moving into 2024. But looking at the 2 wars you spoke of, while obviously there's been tremendous human toll that's taken in Ukraine and in the Middle East, So far, fortunately, those have remained, relatively small regional conflicts that haven't affected the global markets all that much. Now, obviously, if they would expand, if Putin would attack, Poland and get NATO involved to a larger degree, or if Iran would become more aggressive in the Middle East, obviously that changes the equation here. But so far, those have remained pretty minor, relatively speaking, incidents on the global equity markets. We're seeing inflation moderating. So it looks like the Fed is what they're doing is having a positive effect. So if we continue to go down this path of inflation continuing to moderate, there is starting to be talk of now maybe the Fed can engineer a soft landing and be able to work through this without tipping the U.S. into recession. It's rare that happens. From my understanding and looking at the historical data, it's really kind of only happened once, and that was in kind of the early 90s, 94. They were able to successfully tighten pretty drastically without putting the economy into recession. So there's been more talk about that, as we haven't seen, although the economy has begun to, from a inflation standpoint, inflation's coming down. We are starting to see forecasts of a little bit of a slowing economy, but the unemployment rate is still incredibly low. So the U.S. economy has still been very, very resilient. So I would say looking forward, 2024 still seems like could be a fairly positive year, but obviously things can change dramatically. Now, as far as the presidential election, the DFA, our great partner, Dimensional Fund Advisors, we use a number of their funds in our models. They looked at historical performance, Democrat administrations versus Republican administrations, and you really see very little difference in returns between either party. So I'm not, and the market doesn't seem to be all that concerned about the upcoming presidential election, nor does it seem to be all that concerned about the two conflicts going on right now. So everything is pointing to a fairly good 2024. I'm not saying it's going to be great, but a reasonably good 2024. So could it be different? I mean, it could, but at the moment, the market has priced all that information in and seems to be projecting out a decent 2024.
Clark, one thing I'll add is obviously it's scary what's going on. War is never good, but from a historical context, if you go back to a long time ago, World War II, from 39 to 45, obviously we didn't join until 41, but returns were actually positive in the U.S. stock market during that time. Germany invaded Poland, which really got everything going, and markets were up like 9 or 10% the day after, which you would never think that. So trying to judge geopolitical events and what's going to happen in the market, it's a really tough thing to do, as Brian mentioned.
Thank you. So I'm Dee Dee Bloom, and my question is more general, but we talk to our clients a lot about exchange traded funds and mutual funds. And I'm just wondering if you can explain a little bit about the differences between them and if there's any advantages or disadvantages to either one of them.
Sure. Yeah, happy to opine on that. So there's some pretty, ETFs have really, exploded in popularity over the last few years. And there's been some fairly significant changes in the law that's kind of allowed ETFs to flourish over the last couple of years. So the biggest difference between ETFs and mutual funds is essentially how they trade. So when you buy a mutual fund, you place your trade some point during the day. All those trades are grouped together, and then at the end of the day, when the net asset value of the mutual fund is struck, everybody buys whatever number of shares at the net asset value at the end of the day. So the mutual fund manager, I'll just use DFA as an example, they will get all that cash, and then they will turn around the next day and purchase securities with that cash. Now, the opposite is true when there's net redemptions. When there's more sales, DFA has to come up with the money to redeem those shareholder assets. So they have to trade within that portfolio. They've got to sell equities, bonds, whatever the strategy is to meet those demands. So ultimately, you have the fund manager has to trade within that underlying portfolio to either buy more securities or sell securities to meet redemptions. And that's why you'll see kind of we're getting into the season right now, year-end distributions, why you'll see some funds have capital gains distributions. Well, they've had to sell shares during the year to meet distributions or to reposition their portfolio. Now, ETFs, on the other hand, trade on an exchange as opposed to through that process that a mutual fund is purchased or redeemed. So if I wanted to buy a share of an ETF, I'd go to whatever exchange it's traded on, and I'd buy it just like any other security. So the price will be moving throughout the day, and I'll buy it. Now, typically what's happening is, unlike the mutual fund trade where I'm giving cash, receiving cash from the mutual fund, in this case, since it's on an exchange, I am buying it from another investor. So there's another investor out there that wants to sell it. I want to buy it. We exchange shares, and the ETF sponsor doesn't have to trade any securities in the underlying portfolio there. I'm just trading, I'm just buying my interest, or I'm just buying an interest from someone else. So there's a little bit of a tax savings there because there's less, there tends to be less trading in the underlying portfolio for that reason. Now, if there becomes an imbalance, if there's more, let's say there's more sellers than buyers, what happens is the price of that ETF will start to decline relative to its net asset value. And what will happen is you'll get a big bank, a big wirehouse that's what's called an authorized participant. What they'll do to kind of police that is they can make an arbitrage trade. So if the price of the ETF is, just to make the math simple, $10 and the net asset value is $11, they say, hey, I can go buy this on the market. I can go buy shares of the ETF, tender those shares back to the ETF sponsor, and the ETF sponsor will give me the underlying securities. And I can sell those underlying securities on the market and make that dollar profit. And that'll move the price of the ETF back closer to its net asset value. The nice thing about that trade, though, is because the ETF could get rid of shares in kind and not have to sell them on the open market, they don't have to realize as much in the way of capital gains, and they just don't have to trade as much. So the main benefit of ETFs is a tax benefit. They typically spit off significantly less in the way of long-term capital gains. That's kind of the main benefit. Now, what's changed though is over the past couple of years is typically ETFs were basically, the way the law worked, you had to give a pro rata basket, not to get too deep in the weeds. That basically meant it was pretty much limited to mainly indexes. It was ETFs were mainly just index products. What happened in late 2019 is there was a change that allowed ETFs to give out non-pro rata baskets. And so what that allowed basically more managers to do is run strategies, like DFA, small cap value strategies, those are strategies allowed them to run those strategies more efficiently and do that in ETF form. And that's why you've seen kind of a lot of mutual fund managers like DFA has converted a healthy amount of their tax advantage or tax managed strategies into ETFs. So convert those mutual funds into ETFs. And that's why you've also seen many more, actively managed ETFs come into the market over the past couple of years.
Just one thing I'll add real quick is from a total return perspective, whether it's a dimensional funds mutual fund or ETF, we expect the returns to be very close. And the managers that Elevate use in the mutual fund format, historically, they've done a really good job managing the tax situation. So there's not a right or wrong. ETFs are in the news. There are some tax advantages, but the mutual fund managers that historically we have used and Elevate have used do a great job running those mutual funds.
Thanks, guys. Hi, Chuck, Vickery, Brian, Mike, thank y'all for being with us. Brian, you sort of touched on this a little bit already, but the question that I keep hearing is, are we going into a recession? And you talked about the inverted yield curve, all the increases in interest rates. So I just sort of get some people that are, I'll call them doom and gloomers. Oh, things are just going to be terrible. We're going to have a recession. We've got this election coming up and that screws everything up. There was actually an article in the Atlanta paper yesterday that 32% of the people think if their party doesn't win, we're going into a deep recession instantly with the election next year. So are we in a recession? Should we be worried about increase in interest rates? Should we be worried about inflation? Sort of, and maybe I'll just add a little something to that. How do we get through all this with our portfolio? Do we make a lot of changes, or what do we do?
Yeah. So, I'll tackle the last question. You shouldn't make changes, tactical changes to a portfolio based on, what the market thinks is going to happen. Like if you would have done that at the end of 2022, looking back there was much the same doom and gloom at the end of 2022. And if you would have traded out and said, hey, look, it looks like we're going to get a recession here. Interest rates are so high. Inflation is still, up there. I'm going to pull back on equities. Well, you would have missed out on incredibly good returns in 2023. So I would say, look at your plan, and if you can take risk off the table and you don't feel comfortable in the markets, do that, but don't make changes based off of economic forecasts, because that's exactly what they are, a forecast. There's could very much be wrong. Like I said, everybody was basically predicting a recession in 2023. We didn't see that. In fact, the last quarter we got 5.2% real GDP growth. So we didn't see the recession, and now most of the talk, at least market-wise, tends to be, that hey, the Fed might be able to pull off, the quote-unquote soft landing, which means, getting inflation down, using interest rates, and not tipping the economy into a recession. Could it happen? It might. But I would urge clients, don't make tactical asset location or asset decisions based off of, what the market is saying or what forecasters are saying out there. Do we still have to worry about a recession? I mean, I can't say there's not going to be one in 2024. The market doesn't believe there's going to be one, but we could certainly be wrong. I am not as concerned about interest rates. The Fed has already raised it to, basically the 5.5% mark here. It looks like inflation is going in a very positive direction. So would not anticipate, unless we would see inflation really start creeping back up again, I would not expect the Fed to raise interest rates again. It looks like they've kind of given all indications that they're in a holding pattern here to see where inflation goes from here. And as long as it continues to go in the right direction, I see interest rates either staying here or the market's actually looking at inflation rates being cut, or excuse me, interest rates being cut in 2024. There's no recession right now. We're not anywhere close. We would need to see at least 2 quarters of negative GDP growth for there to be a recession. And even then, if it's minor, they might not even declare a recession. If you remember back to 2021, the first 2 quarters of 2021 actually were negative growth, but that technically wasn't a recession because it was not declared one by the NBER. So, things look fairly good right now. But again, that is just where we sit today, and markets can change pretty quickly. Nothing as far as looking at things from the outside, nothing to be overly concerned with at the moment.
Thank you.
No problem.
Okay. We've had a lot of people asking about cash and what to do with their cash. A lot of questions about CDs, and with interest rates the way they are, if people should put their money into CDs. So can you talk a little bit about the difference between CDs and money market accounts?
Sure. So
just to clarify, are you talking about bank CDs, CDs you would purchase at a bank, or?
Yes.
Okay.
So, full disclosure, we use not bank CDs, but we use brokered CDs in our individual fixed income portfolios. Essentially, they work the same way as any other fixed income security. There's a coupon, there's a maturity date, pays regular interest. You can buy it and sell it whenever you like. But as far as bank CDs go, obviously there's many different flavors and many different rates out there. But I would say for the most part, what we've seen at a lot of banks is with the economy slowing, with lending starting to trend down, we've started to see basically bank CD rates come down. Essentially banks just don't need the cash right now. There's just not the loan demand. So there's not the incentive to have higher bank rates out there. Not saying you might not be able to find one at your local town, your local bank that might be a little higher. Can't say it with any certainty, but for the most part, we've seen bank loan growth really, really slow, which makes sense with interest rates being significantly higher, and the expectation that consumer demand will eventually start to slow. We've seen lowered lower CD rates. Now, I would urge clients, if for money that is truly for living expenses, there's some great money markets out there to use that are, there's treasury money markets paying north of 5%. What I would urge clients not to do, though, is to park everything short term, to park your fixed income investments in short-term interest rates. And the reason for that is you are introducing a healthy amount of reinvestment risk. So obviously money market rates, those are heavily tied to short-term interest rates. If the Fed would start lowering interest rates, you could go from something that has yielding north of 5% that is only yielding 4%, maybe even lower if the Fed is even more aggressive. So you're introducing a healthy amount of reinvestment risk. We would still urge clients take a little bit of duration risk. So go out to maybe 4 or 5 years and buy some of those bonds to lock in these yields in case interest rates do go down in the future. I mean, honestly, I've been in the fixed income markets since 2003. So almost 21 years, early 2003. Interest rates have never been this high in my professional career, aside from the very beginning. So please, we would urge clients to lock these in a little bit and not sit in money market, because if interest rates go down, you're going to get whipsawed, and it could happen quite quickly.
Thanks so much, Brian and Mike, and everybody else too. We do have a couple questions from viewers, and viewers, if you have additional questions, put those in the chat box or the Q&A box, but I'll go through a couple of these real quick. The Tax Cuts and Job Acts, it sunsets in 2025. So what kind of things should I be focused on until then? Brian or Mike, either one of you want to take that one?
Yeah, so I can take that. The Tax Cuts and Job Act does have a potential sunset. I mean, everyone knows that, Betsy. So I don't think there's a lot that you're going to act on from your investment portfolio. What you need to be cognizant of is potentially it could raise taxes. Taxes in most tax brackets go up. And then it will significantly lower the state tax amount. So a lot of ultra high net worth clients right now do not have an estate tax issue. That could change. So that may be something you want to talk to your advisor with. The other thing just to be cognizant of is that whenever there's change in estate laws, if you need changes done with an estate tax attorney, they get very busy during that time. So again, I would work with your financial advisor, try to determine if there's going to be any impact to your situation, and if there is, to get ahead of it. Now, with that being said, depending on what happens in the elections, we could see it pushed out. We could see it extended. I don't think permanently. But we don't know for sure that it will sunset. But again, I would work with your advisor on your personal situation.
Thank you so much. And this kind of segues into the next question. Why is estate planning or long-term care planning so important? Dee Dee, as our advanced planning coordinator, do you want to take that one?
Sure. Well, at Elevate, we try to plan for what we can control and try to invest in ways that are smart and in the risk tolerance for our clients that are appropriate. But we also like to try to plan for the unexpected and what we cannot control. So the advanced planning part of our firm is just to take into consideration those things that are outside of our control and just to analyze the risk and the liability that we have and see if we can assist with planning for those unexpected things. So long-term care planning, estate planning, all of those things are part of that.
Awesome. Oh, and now someone says, I hear from Elevate a lot, focus on what I can control. So what exactly can I control? Deanne, would you like to take that one?
Sure, I'll take it. I know that must have come from a client because we say that a lot at Elevate. Focus on what you can control. That's a mantra that we live by for our clients. And for everyone, actually. Today, we've spent a lot of time hearing from Brian and Mike and our advisors in our firm about markets. And that's one of those things that we can't control. It's one of those things that we want to learn about. We want to be educated about. We want to have some forecasting on so we kind of anticipate things or know what to expect, but we have no control over it. So what are the things that we can control? Well, we can control costs. We've heard today about the differences in mutual funds and ETFs, and we work with every client individually to determine what is most cost effective for their portfolio. We can talk about taxes. We just talked about Tax Cuts and Jobs Act sunsetting in 2025. So what tax things can we take advantage of before those things happen? Or what tax strategies can we take advantage of in your portfolios or for your income stream that will help make a big difference in minimizing your income taxes over time? We can control risk. How much risk is appropriate in our portfolio? That's really how we control market risk, is making sure we get the risk right. So those are all things we can control. I think the last and most important thing, or there's other things we can control, but the fourth thing that, in my opinion, is one of the most important things that we can control is our behavior. And what I mean by that is the choices that we make when it comes to managing our portfolio and our financial planning overall. So famed advisor and writer, a financial writer, Nick Murray, and I'll paraphrase here, but he says, the most important determinant for a portfolio's rate of return is the behavior of the investor themselves. So sticking with a plan is super, super, super important. So those are the things that we help our clients focus on and that we think, will really determine your success in the long run. So yeah, and I'll keep saying it, focus on what you can control. That's what we're really here to do.
Excellent. Those are all of our questions. And I really thank every single one of you today for the time that you put into this webinar and this roundtable. We will be putting this on our YouTube channel later today. So we will send a link out. And again, feel free to share that with your friends and family. And if you have additional questions, email them to marketing@elevate-wealth.com. Keep up with us on our website, elevate-wealth.com. We're going to be listing all our 2024 webinars on there. So be sure to register for those. And always, if you have any questions, please reach out. We're here for you. We care about you, and we hope you have a wonderful holiday. Bye, everybody. Thank you so much.